A few Fridays back, Indian markets posted their biggest decline in one day in 10 months. Subsequently, 4% fall was posted in just 5 days. Is that the end? Is that the beginning of the end? Should one continue to invest in such a scenario? Or is it to do with some calculations, maths, and numbers? Or alternately, is it to do with psychology or temperament? Well, all these questions will be answered in today's program, Investors Hangout, which is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. My name is Rajesh Lake, and with me is Dhirendra Kumar, CEO, Value Research. Dhirendra, welcome.
Thank you.
Now, how do we go about investing when markets fall? Why do we say markets are correcting when actually they were incorrect?
No, we have created these jargons ourselves, and I think it has more to do with the ball by ball tracking of the markets and markets. In fact, it came as a surprise when non-market people, when they face this, as if correction in the market means that when the market was doing well, it was incorrect. I think we need to really
Correct.
talk in plain English.
Okay.
That markets fall, markets rise, and in fact you would have come across this expression quite often, that when markets fall, people also say the market has been volatile.
Yeah.
It is not volatility. A market, volatility is when something is oscillating in a certain range. It should not be looked upon just as a negative, a decline in value. But I think it's understandable. People get very anxious about the market fall, when market fall, because the general nature of the market is that markets, even if they are doing well, they rise steadily, and they fall. In a brief period of time, they fall quickly. So that is quite unnerving. It's almost like it takes very little time to fall, and it takes long time to repair. If you fall in the bathroom, you understand that analogy. So it takes time to recover. So markets rise steadily, fall quickly, and every time but this is actually the trap that scares people, and that's what deprives them of using the market. Because whenever you look at 5 years, 10 years, 15 years graph, you see the big mountain, and when you see those mountain, see that mountain, you find that okay, this was the time when I should have bought. Everybody looks at that past thing and says that this was a great opportunity. And when you are faced with a 5% decline, 3% decline currently, then you look at it with fear. You are scared of that. So I think this is something which investors need to really understand, and there are ways of dealing with it in terms of because you deprive yourself of the huge opportunity by getting unnerved by uh, getting upset with this intermittent decline, because that is the nature of the market. It will remain like this only. It will always be like that, and it has always been like that. You see the past, you get inspired by the kind of opportunity you might have missed. You look at it as a missed opportunity, and here you look at it as a huge risk, and that actually drives you away.
So what should one do when the market fall is quite huge?
Do nothing. Uh, uh, but only do nothing only if you have 2-3 variables in place. One is that you are a long-term investor. If you are actually, if you have invested your money, which you are likely to need in a short period of time, so any amount of comfort will not do the job, because it's understandable. Markets in the short run can surprise you. So one, do nothing only if you're a long-term investor. If you are a regular investor, then also you don't have to do anything, because this will come as an opportunity. You will be doing things which will enhance your return when the markets go down. Third thing is that being in appropriate kind of vehicle, because even if you are doing your SIP and you are a long-term investor, but if you are in a small cap fund and you see that the market went down by 4%, but your fund went down by 15%, that is the nature. You have full range of things to choose from. You will have the equity income fund. These funds invest only 33%. A third of the money is in equity, a third of the money is in fixed income, a third of the money is in arbitrage position, which means by very design This is 66% fixed income, 33% equity. They are far more steady. They don't crumble when markets fall. So these are, this is meant for the most conservative investor wanting to enhance his return, expecting little more return than fixed income, fixed deposits, and deriving the return in a more tax efficient manner. That is for the most conservative investor. Then comes, then comes the balanced fund. These are 2/3 equity, 1/3 fixed income. That is also meant for a person who has never invested in the market, wants to start with a steady take. They will be more volatile than those equity income fund, but less volatile than the multi-cap fund. Then consider those large caps and the multi-cap fund. They are relatively steadier of the equity. They are better diversified. But they are 100% equity fund. And what I was referring to as the small cap fund, the funds which can actually go down by twice as much as the market when markets fall, that is meant for the venture sum. It is not easy for most investors, and in fact this is where the biggest mistake happens. Investors look at the past performance. They find that, and in a good market, they are attracted to those small caps because they generate more return, and they start investing in those. And then whenever an intermittent correction, market fall, I'm actually trying to control myself from saying correction, because it's not correction. It's a intermittent market decline or fall that drives them out of the market. It scares them because they fall so much more. So being in the appropriate kind is extremely important for most investors.
So what Dhiren is saying, that if you are a long-term investor, if you're a regular investor, the third was
being in the appropriate kind of fund.
An appropriate kind of fund, which he explained in detail. If you have all these three in your being or as an investor, then you don't have to worry, right?
Yes.
And you don't have to do much. All right. If we are in a bearish, you mentioned about these are the terms that we have coined, volatility, market correctness, etc. So there's another term, bearish and bullish. So what do we do when the market is bearish, which we talked actually Dhiren did explain, and when we are very bullish, what should we do as investors?
Once again, the same answer, that do nothing.
Nothing.
Stick to your plan. If you are a long-term investor and if you are in a bearish phase, bearish phase is, prolonged phase in the market when the market is not going up. It is either declining or stagnant. And that is the bear phase. That is when, markets are not going up, and that is a great thing for many investors because you are able to buy cheap. In fact, the ideal thing will be that, if I'm investing for 20 years and for 19 years, the market remains in a bearish phase, is bearish, and I'm investing. Of course, it's a very hard thing for anybody to keep investing while it's not generating return continually. And in the last year when I need the money, it should recover for all the money. It should generate 20%, or it should go up by substantially. That will translate into great return for me. But markets are cyclical. Markets go up and down, and so stick to your plan. If you're a long-term investor, if you're in the appropriate kind of fund, investing regularly, things will be taken care of. You really can't plan for the bear market and the bull market, because when in the last 25 years, ever since I've been watching markets closely, markets turn around when you least expect it. When you thought that the bull phase has been established and this is going to last forever, you see the biggest decline. When you think that the market is over, nobody is going to invest in markets ever. That is when the biggest boom happens. What we saw in 2003 was the market was at 2,800, and in the next 7 years, in next 4 to 5 years, it went up by nearly 7 times. 2,800 when we launched our mutual fund insight to 2008. Market went up to 20,000 points. This was a substantial jump. And then when everybody thought that things have been sorted out for the Indian market and markets are on tier, that is when we saw the biggest decline, 50% fall in the next 8 months on the Sensex. But despite all this, the market has been able to generate 18 to 19% return. This is the nature of the beast, and you have to ride it on your strengths.
Okay. And also, the human tendency, more often than not, is to take out their books, take out their calculators, and start calculating. Maths, numbers come into play, as I said in my opening remark, and also the human psychology and temperament comes into play. Virendra will touch on that now.
Uh, it's very difficult for investors to be unemotional about it, because when you see that you are investing 5,000 rupees a month and it has become 60,000 of your accumulation and gone up by 20%, and then you see that in few days it becomes less than what you invested, it becomes 55,000 rupees. It's a shock. I think the way to deal with it is, don't look at it very closely. Don't look at it every day. Don't look at it every month. Think in terms of what. And I think any investor who has been through one market cycle, if you have seen those 2 years of decline or 3 years of rising phase, then I think you will understand it. Because any amount of listening to our investor hangout will not help, because you have to really experience it. It's real money. So it's important that you stick to a plan and believe in that plan for at least one market cycle. That could take 3 years, that could take 4 years, and once you are done with, and that is why for the first time investor, that appropriate kind of fund is crucial. Because if you start with a fund which is very volatile, it declines in value substantially. Because if you invested 60,000 rupee and it becomes 55,000 rupee is one story. If that 60,000 rupee becomes 30,000 rupee, then it's a completely different story. You start questioning your belief. You start doubting what you have been doing. So and for the first time investor, I always urge that stick to a plan which is conservative. Developing that belief is important, and then you have all your life to capitalize or benefit from this. But without that belief, without getting scared by the market, getting a blow at the outset drives you out. When you never you keep cursing. I come across a lot of investors who invested in 1992, who invested in 1998, 98, or they invested in 2005, 6, never to come back again. They invested as a short-term investor. They were not a methodical investor. And people who invested, in 1994 when the private mutual fund was coming up, or IPOs, they invested, they lost, never to come back again. They became a fixed depositor, and they missed on the huge opportunity. When I was referring to markets going up from 2,300 to 20,000 in 2008, after that 50% decline, the investors who invested in the infrastructure fund in 2008, they lost money, never to come back again. So being methodical about this is important.
So that brings me to the next question. In the times when we are going through upheaval in the market, should we continue with our SIP?
Absolutely. If you are not doing it, then you are in trouble. Because if you try and time it, in fact, our instincts are injurious to us, in terms of, when you see the market fall, you stop your SIP, which means, and quite understandably, that you are scared of the market, you don't want to lose more money, and you should be doing the opposite. You should be investing through the bad times, through the lean times, because that is the time. But it's very difficult to time it. So investing, continuing your SIP is going to be one of the most important thing for investors to optimize their return. Because if you invest only in a rising market and don't invest in a falling market, then you have lost it.
Yeah, absolutely correct. So these were the questions actually related to our topic, what to do when markets fall, and these were asked by Dharmel and also Kamal, and we've taken care of your questions. Just to let you know once again that you are with us on Investor Hangout, which is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research, and it's time for us. Before I go to the other questions, anything else you want to add on?
No, I'll deal with because I see a lot of questions.
Okay.
And I think ideas will come up, or whatever I have to share in the context of these questions.
So we go to Abhishek's question, who has recently invested in small and mid-cap funds, asking how long will he have to wait to see decent returns for both SIP and lump sum investments that he has done. Kab milega paisa?
In fact, this is where you need to really work hard in terms of managing your mind. because you saw the past numbers, you saw the past SIP numbers, and
Right.
you saw the phenomenal return. You got attracted, you invested, and then you see that they have become shaky. You saw the big decline, 5% decline in a month on the Sensex, or 3% decline in the Sensex, but the mid cap fell so much more. Or the small caps actually crumbled maybe 3 months back. Or the market is rising, but a certain segment of the market was falling, and so you find. I think if you have a long-term view, I don't know about the lump sum, because it is entirely a function of when you invested that big amount, and how long will it take for you to break even. But I think you only have I always suggest in terms of controlling the controllables, not in terms of, because many things you don't have a control on. You continue your SIP, because you'll be able to average. Make sure that you are in a high quality mid cap or a small cap fund, because high quality meaning look at the company, look at the investment philosophy, is the fund manager, because don't just get carried by the past performance, because the small cap and the mid cap can also be a trap. They are the funds which actually take the biggest risk. They might turn out to be most rewarding at a certain point, and they might prove to be the disastrous ones too. So being little conservative with your opinion, understanding with your selection, understanding what the fund manager is trying to do. The fund manager must have a fundamentally guided quality focus, otherwise you will be in for disappointment. Lot of the range of return that is available in small caps and the mid caps is wide. When you look at the large cap fund, you find that there are funds which are the return the best fund and the worst fund could range between 12 to 15%. When you look at the small cap fund, you find that it is -10 over the past 1 year, and it is +30. This is a wide range, and the fund manager's ability to add substantial value with his selectivity, with his foresight, with his brilliance, is high. So it's important that you choose a fund manager who has been through a full market cycle, who has a quality focus, because quality focus, I think, is the most crucial thing, and it's a hard thing for investors to decode.
You mentioned a lot of trap, the word trap, that it's a trap. So what is safe then?
Uh, you derive safety by these 3-4 things. One is that your ability to average, the convenience of being able to average. The other is diversification. I would say that if somebody is investing in mutual fund for the first time and is concerned about safety, then he should not start with a small cap and a mid cap in the first place. He should start with those equity income fund, those 33% into equity, or the balanced fund, or the tax saving fund, the conservative ones, so that you get stuck for 3 years and you are forced to experience the joys of equity or the rewards of equity.
Correct.
So that should be the starting point. Don't get venturesome at the outset.
Okay. We take on our next question. Mr. Patils asks if we can invest in mutual funds which are showing good return but have meager AUM.
Yes, but just look at how the fund manager, how long he has been around, and what he thinks. And if the fund has done well, I would say that most investors stand a superior chance of the likelihood of deriving superior return from a relatively smaller fund is high as compared to a large fund which would have delivered big funds. Actually, there's something called a winner's curse, that a fund starts small, does well, more investors put in money, and it becomes big, and it becomes difficult for it to replicate its performance. So, so you are actually a victim of your success. So, if there is a fund which you are able to spot that is small and has done very well, it is definitely not a disadvantage. I think there are some disadvantage only when many funds turn big.
Okay, the next question is kind of interesting. There's a lot of turmoil or volatility happening in the geopolitical arena worldwide. So if that happens, I think keeping an eye on the volatility of the mutual funds or the markets per se. Mr. Amiseti has asked, what stocks should he pick up in the given scenario, in the given geopolitical scenario?
Geopolitical scenario is always like this. There is something or the other which is happening. Today it is North Korea. yesterday it was, it would have been India-Pakistan tension or something on the China border or something in the US or something in the Gulf or
Right.
so, something in the Gulf happening, or what happens in Syria has a bearing on the oil supplies. And so world is like that only. And
Something or the other
something
will
or
keep
the other
on.
will
Yeah.
happen. Sometimes we have, and I don't think you can devise a strategy. Try and find high quality business. If you can't do that, try and find a person who is good at finding high quality business.
The fund
And
managers
a fund
come.
manager, you entrust your money.
Yeah.
And then invest regularly, because markets will be like this. Either it is geopolitical or economic situation which will cause all this turbulence. Sometime we were worried about the what was happening in the US, the interest rate and the kind of impact it will happen on it'll have on Indian markets or the world market, or something or the other will. Brexit happened, we thought that there is a big thing. So don't worry about that. If you have a high quality business, you have to think in terms that, will this business continue? Will this business exist? Will consumer buy the product? Will the company make profit? And that, I think, is the primary driver. Because of these geopolitical events, there could be an impact on the market. Money can move. There are two drivers to the markets in general. One is high quality business, which is generating money, will be priced at a certain level. And then if a lot of money is finding its way into the market, if a lot of investors are coming and they're in a stable set of, they actually think positive or optimistic about that particular segment or the market or the geography, that can get disrupted for a while. But I think over a period of time, what Warren Buffett said was that in the short run, the market is like a voting machine. You can't really get a sense of it. But in the long run, it is a weighing machine. If the company makes money, or the companies or the set of companies that you are buying makes money, it gets valued and it gets rewarded.
Okay. Interesting answer. And moving on, another interesting question. Now, Ayushi is a finance graduate, and she feels that this is not the right time to invest. She expects mean reversion, and she wants to know if her opinion is correct.
I don't know. And yes, markets are cyclical. Things revert to mean. But there are a lot of exceptions to this.
Okay.
We have seen a phase in the market when things look very expensive and they remain expensive for a while and they become even more expensive. Also, what I was saying in my previous answer, that mean reversion on the Sensex might be a possibility, but that doesn't mean. There has been situation when the market has fallen by 30%, and there is another fund which has a great fund which has fallen just by 10%. That I think they revert to mean. But the fund which has fallen only 10%, and when the market recovers or when the market goes up again, the other fund which fell only 10%, the market went up by 20% again, and that fund went up by 40%. So there can be a phase. I agree that if markets fall, markets look expensive, but I don't know when they will correct. The dynamics are extremely favorable for the market. A lot of investors, foreign investors, domestic investor, mutual fund investor, the mutual fund Sahi Hai campaign is all having an impact. The decline in interest rate, the fall of gold, the fall of real estate. I think these are two bigger, these are big drivers. So market may not fall even if they look expensive or they should revert to mean. Then there are funds which will be an exception to the rule. There are funds which will crumble. So selectivity is what matters, and I think you don't have a control on this. When the markets will correct, you will be too scared to catching a falling knife.
True.
That's just as hard. So develop a plan and stick to it.
I remember
managing the controllables,
few weeks back we did this program where we said how to choose a mutual fund.
Yes.
And so
How
it's
to choose the mutual fund and how long is long term.
how long is long term. So please, if you want, you can go back to those programs and look at them and find the answers. Moving on, does it make sense to invest in PPF or LIC endowment plans to balance out the mutual fund portfolio? And this is asked by Jastev.
Maybe PPF, because PPF is least expensive, and reasonably rewarding. And the charm of PPF is that all the return that you have comes in a tax-free way, but it may not be the finest way. If the whole idea of PPF should be that you are getting a fixed income allocation to your overall portfolio. If you have 50 lakh rupee invested in the market, or in all your total financial saving is 50 lakh rupees, then 10 15 20% should be fixed income. How to get it, and is it an efficient way of moving back and forth if the allocation changes? If you want to have 20% of your total financial net worth into fixed income, is PPF efficient way? PPF is tax efficient. All the returns that you get on PPF is reasonably okay and tax free. But if you want to increase your fixed income allocation, you can't do that. It is not very liquid because first 5 years you have a lock-in. So I would say that do it with an asset allocation, do it with a fixed income fund. Because that also, if to be held in a long-term way, if you're holding it for 3 years and more, it becomes extremely tax efficient. But PPF you can still consider. LIC endowment plans are bad. You should not.
You should say they're bad.
No, they are actually very low yielding, and it's a mix of insurance and investment. The investment returns are not so good, and the insurance coverage is also very poor. So as I keep saying, that never mix insurance and investment. So buy a term plan for your needs, your insurance needs, and endowment plan keep away.
So Dhiren has his reasons why he's saying that you should stay away from LIC endowments, and there are valid reasons as well. Moving on, Jennifer says she's rented out her flat in Mumbai and she's got deposit money for 2 years. In what type of fund should she invest this money for better returns than fixed deposits?
Invest in a short-term bond fund. They are reasonably safe. 2-year time frame, they will give you superior return than fixed deposits, and the return will be taxable, because for it to be tax efficient, any investment in fixed income fund should be held for 3 years and more.
Okay, so Jennifer, do the needful and you will be rewarded. Mr. Chaturvedi also asked how a portfolio should be split between large cap, mid cap and small cap funds. Also, what should be the upper limit of investments in a single fund house? Tricky question.
But I would say that the way we go about defining, there is the first part of the question is pretty straightforward, because the way value research classifies all the stocks on the stock universe, 70 stocks accounting for large cap, what we define as large cap, they account for 70%. About 65 stocks account for 70% of the total market cap. Next 20% is accounted for by another 350 stocks, and the bottom 10%, which we call small cap, there are about more than 1,000 companies, small companies. So I would say that you should follow the same split: 65 to 70% into large cap, next 20% into mid cap. So 20% of your portfolio should be in mid cap, and bottom 10%, 10% should be in small cap, ideally. And you will get the finest exposure. And if you entrust it to a fund manager, you will get selectively the exposure to the full market. And I think diversifying across the breadth of the market is important. Which fund manager? I think it's a function of scale. If you have plenty of money to invested in the market, invest in no more than 4 funds of 4 different fund companies, and it can also be reasonably achieved with just 2 funds. Whether it be a tax saving fund or a small cap fund, if you have, or 2 multi-cap fund of 2 fund companies will also get you that, or 2 balanced fund of 2 different fund companies will get you. The whole idea of diversification, I don't know, is there a formula to it? But the whole idea should be that if a fund manager goes out of favor, some accident happens, your money should not be completely, the whole idea of diversification is that you are hedging against the risk of something going wrong or something turning bad. So insurer, it's like buying insurance, or taking that view. At least 2, max 4.
Okay. I just want to ask you this question: value research website, if they go there, will they be able to find all the funds listed
Yes,
there
yes.
and the choice, and will they be guided through the website?
Yes, all the CAT classes, all the funds that are, value research online has a full coverage of the domestic mutual funds. So you will get information on every fund classified by category. But I think, better way there are two ways of looking at it. There are investors who are exploring funds to buy and they have no exposure there. So you can value research online helps you do it yourself. The other is there are a lot of investors who have bought something or the other, and they need to really get a sense, get a control or pointer to how they should go about doing it. Set up your portfolio at Value Research Online.
Okay.
You will be able to track your portfolios better.
Will they be guided as
They
well?
will be no, you will not be guided, but you will get a lot of hard work being done by the website in terms of getting you pointers, because the whole idea of Value Research Online is to help investors do things themselves. We tell them how to go about doing things, but we would like them to do it themselves, because Value Research Online or Value Research Company is not an intermediary. We are aggregating information, we are doing all the dirty work, or all the hard, not the dirty work, but hard work, putting things in
So
perspective,
that
helping you
DIY
understand.
can be done by the
Yeah,
investors.
investors can do it themselves.
Okay, let's move on to the questions now. Mr. Narayanan says the SIP dates have always coincided with market recoveries. What an insight, huh? Making him rather unlucky. So, should he opt for lump sum investment when the market falls instead? This is his
Poor coincidence,
turned
but
everything upside down.
no, but I think it is just a coincidence. I really wonder that there will be any signs to this, or there is a pattern to this. In fact, all uh, just just go little longer in the past, and this trend may not be there. And I would urge you to resist this temptation to do a lump sum investment. Also, what happens over a period of time is that SIP becomes a habit. But once you have some meaningful allocation, the contribution of SIP in your total financial worth, assuming that you are so you are closely watching it, because you might be a new investor. So assuming that I am doing my 10,000 rupee and last SIP, last 1 year I have seen that 1,20,000, and all the days on which my SIP was invested was actually high. But the critical thing to understand is that at any given point, all the money which was already invested would have also gained your accumulation. So just the fact that your new money, that particular installment, that particular 10,000 rupee was bought at a point which was higher than the previous one, which is bad news, but at the same time good news for all the money which was already invested. So don't look at it very closely as you are getting started, and I think in 3-5 years time you will understand that what magic it does.
Okay. What's your opinion on gold ETF? And that's the next question.
My general
But
opinion
Teja.
on gold as an investment is that it is not a, Indians are fond of gold. They should buy jewelry. It's a consumption. And we pretend it to be an investment. My long-term view about gold is that it's an unproductive asset. And whether you buy it in the form of sovereign gold bonds or ETF or a gold fund, it doesn't help. Equity and fixed income are the core asset, financial investment. That is something which should be pursued, and nothing else. If at all you need to have some, there are different things that will government is about to offer something which is a recurring deposit in the sovereign gold bonds of the kind, it's in the planning phase. So that is something which should keep an eye on. But as an investment, keep away from gold.
Quickly,
Long-term
this question, okay. Madhugala has asked if Deepavali is the right time to exit from mutual funds. What is the reason behind that? I don't know. But Deepavali is just around the corner. So should one
No, I
exit?
think Deepavali is a bad time to exit your investment, simply because that is the time when we are in a fairly spending mode,
Right.
and it's not a great idea to be cashing your investments at the time when spending that money is quite tempting and is trendy.
Well, these are the questions that we could accommodate in today's program, and I'm sure that you all have learned how to go about investing when the markets are falling. and that has been answered quite adequately by Dhirendra. It's time to wind up. We will be seeing you very soon, and till then, please continue to invest.